as we try and make some sense of some of the revisions that we got, as well as this hot headline print, Brian, I want to go to you first. You know, as we think about this kind of market reaction that we're also seeing here too, what do you think investors are trying to get ahead of?
It's not a bad report. We continue to show strength in the jobs data, which is good, and we didn't see wages climb on a year-over-year basis. I mean, they climbed 4.1%, but the rate of change was good, and so it's a pretty Goldilocks report. And I think everyone's been so focused on how many rate cuts we're going to get. Remember, rate cuts would have been aligned with some softness or some weakness in the economy. I would prefer a strong economic backdrop and a Fed that goes about this slowly. So I view this as all favorable news here.
What do you think, Dana? Do you agree?
Well, I'm certainly concerned about wages. I mean, wages are still well above the average we saw before the pandemic. Before that, it was roughly just under 3%. Now we're still at 4%. And so that's going to place upward pressure on overall consumer inflation. The good news is that housing inflation is slowing, but we're still getting that resistance from wages. And certainly when we look at the payrolls, yes, you did have the usual suspects like government, leisure and hospitality, non-res construction, and also healthcare driving a lot of the gains, but we saw some broadening to other sectors. So the Fed is going to be watching this to see if the labor market gets hotter and certainly causes them to pause or at least wait until they need to see more improvement in inflation before they start cutting rates.
Dana, when you see wage numbers like this, like you were just suggesting there, still remain pretty hot overall when you compare it to those pre-pandemic levels, what does that tell us then about the fight to tame inflation and the impact that this is ultimately going to have on inflation in the short term?
Well, we have to ask ourselves, why are wages still elevated? And a lot of that is because you have labor shortage in some of these key industries, especially if you have to physically show up to work. That's probably not going to be solved overnight. And so the Fed is really going to have to resist this and hope that we don't see a redux in goods and energy price inflation, which could be a risk, certainly given the fact that we're seeing shortages in energy and we're having disease and such affecting food prices. So the Fed's got a tough few months ahead of them in terms of feeling confident about beginning interest rate cuts.
I guess, Brian, is the wage front so extreme or so significant that it would throw off some of the expense profiles of companies that we track on a day in, day out basis and try to see how that might impact their margins as well, and the trade that a lot of investors have to think about too?
No, I don't think so. I mean, remember, companies are generating profits nominally, and so we're still in a good nominal growth backdrop. And again, a strong economy will be good for business. Yeah, we may see, expenses up a bit, but we're also seeing very good revenue reports. And if these businesses have done a reasonably good job of getting back the workers. We have to remember why this all happened. This all happened because businesses cut workers and slashed inventory at the worst time 4 years ago. And so we're still coming through that. They're bringing back workers. The inventory levels are better. I don't think we're moving back into a period where we're at price instability, wages are up, corporate earnings are hit by that. I don't think that's what we're talking about. To me, this is a good backdrop of strong growth and prices that may be a little bit elevated, but I wouldn't call it price instability.
Dana, what do you think this is going to do for the Fed's timeline of cutting rates? Does it push off that first rate cut, and does it also make it a bit more likely that maybe we could only see 2 cuts before the end of the year?
Well, I think it's too early to tell. Before the May meeting, we'll get a few more inflation prints from the CPI, the PCE deflator, and certainly in June, which is when we think the Fed might start cutting interest rates, we're going to get even more inflation prints. So I think it's too early to say that the Fed is not going to go the 75 basis points that the SEP suggests, but we do need to watch these data very closely over the next few months.
I was really interested, Dana, in the consumer confidence print that came out just last week, and I was reading through some of your commentary on it as well, and recession fears continue to trend downward, both in write-in responses you mentioned, as well as by consumers' perceived likelihood of a U.S. recession over the next 12 months. is there anything within these reports that we've seen most recent, if we're stringing together different pieces of economic data, that signals to you that, hey, maybe a recession is not coming, or if it's so far out that the Fed has a lot of room to just sit on its hands for a while?
Well, we think consumers are right. There probably is not going to be a recession, but we do think that U.S. growth is going to slow around the middle of the year, mainly because consumers probably are tapped out. They're not seeing the big wage gains. In fact, some people who quit are seeing their wage gains slow pretty materially. And also, those excess savings from the stimulus checks are probably gone, and consumers have racked up a lot of credit card debt, and the interest they're paying is very high. So we think consumers are probably going to rethink their budgets, maybe pull back a little bit on spending, and certainly not buy any homes. And so that's going to help slow the economy over the course of this year. And that actually would provide the Fed with a little bit more room to go ahead and cut interest rates, even if inflation is still a little bit sticky.
Brian, when you take a look at the market's reaction that we've seen over the last couple of minutes, obviously we're still sorting things out here ahead of the opening bell, but we initially saw a dip. Now we're back pushing higher here for futures. Does that reaction here, that gain that we're seeing pre-market, does that make sense to you?
Well, we'll see how the day plays out. I think the initial reaction to the jobs report was aligned with the Fed. We're not going to be able to get these rate cuts. But a market that's up on a strong jobs day in an environment where prices, again, are relatively stable. The cost of living may be a little bit too high, and maybe the rate of change is slightly above what the Fed wants. We could debate that, but it's not a period of price instability. And so, I think the markets should be pleased with a better nominal growth backdrop, an environment in which the jobs numbers are still strong. I mean, that's obviously supportive for spending, which is a large percentage of this economy.
Brian, just lastly, while we have both of you here, if there is one trade that traders, investors should perhaps initiate off of a report like this or think about for their portfolio this morning, off of reading this report, what would that be?
Well, it might seem a little paradoxical, but I still think investors should be looking to lock in yields. And the reason I say it's paradoxical is because this high for longer means people would say, I want to sit in money markets and get what I can get. But this environment's not going to be here forever. Things will moderate at some point. Rates will come back down at some point. So I look at this as anytime yields jump, whether it's treasuries, municipal bonds, high quality corporate bonds, take advantage of it and lock in those yields. This is an opportunity that's presenting itself to investors that may not be back for a while.